Cool. Good evening, everyone. Hi, my name is Jason Mado with American Pacific Mortgage. Thanks for joining us for today's session. And this is our Arizona Homebuyer Workshop, so it's great to be with you guys. This is a very interactive session that we do, and we host these workshops every couple of weeks. So what we're going to do throughout tonight's coursework is kind of review certain topics as it relates to home buying. And then we really encourage questions. So feel free to use the Q&A function. Ken Fleck's going to be helping me with questions behind the scenes. So if you do have some questions, just go ahead and throw that out to us, and we'll go ahead and share those back with the group. So this class will probably run about just under an hour typically. So, but the more questions we have, we're more than happy to stay along online to be able to answer those for you. So let's go ahead and dive in. Just a quick little bit about me. So I'm the branch manager for American Pacific Mortgage. We work across the West Coast, based out of California, but we do a lot of work in the Arizona markets, and we're excited to be a preferred partner of the University of Arizona. So many of you that are joining us tonight is because you received some information about some of the benefits in working with us and our partnership with the University of Arizona. So I've been in the business for just over 20 years. Love what I do. I get a chance to help first-time homebuyers with probably the largest investment they're going to make in their lifetime in buying a house. And so we really focus on education to help prepare first-time homebuyers to take that journey towards home ownership. And we work specifically with first-time homebuyer programs, as well as different lending products like conventional loans, FHA, VA, and USDA loans. We're going to learn a little bit tonight about the Home Plus program for the state of Arizona. So I'll share with you a little bit more about that later on this evening. Okay. All right, so let's go ahead and move on. I think on camera, is our camera off?
Yours is still good.
Okay, I'm still good. Okay. All right. So it shows me that camera was off here. So, okay. So let's talk a little bit about our talking points for this evening. So we're going to look at the housing market. Lots to talk about there. We'll spend some time looking at interest rates, and definitely a lot to talk around interest rates, especially where we've seen a very rapid incline with interest rates. We'll talk about does buying make sense when we're comparing our current situation of renting versus what it could look like buying. Does that make sense for us, and how does that budget for us? We're going to look at credit, give you some tips around credit, how to optimize our credit as we're preparing to purchase. Talk a little bit about student loan debt, loan programs, some of the qualifying income. We'll just spend some time looking at the documentation, as well as the assistance programs that are available to you as first-time buyers. And then we'll wrap up tonight's discussion looking at the process of buying a house. So we call that our 6 steps of home buying. So what does it look like to go from pre-approval across our different milestones to all the way when we get our keys to our house? So I'll kind of walk you through all of those steps this evening as well. So let's go ahead and dive in and talk about, does buying make sense for us? So when we think about buying, as I mentioned to you earlier, it's probably going to be one of the largest investments you're going to make in your lifetime, right? So this isn't like running to the auto mall to purchase a car. It takes some due diligence, takes some discovery to make sure that you're buying smart and preparing yourself financially to get on that journey towards home ownership. And there's a lot of great benefits that come with owning a home. So it's the ability to be able to create stability in your housing payment. This is an asset, so potentially to be able to pass along that asset to heirs of your estate. There's potential growth in equity. So many of our clients in the Arizona market have seen growth in equity. So they bought at a certain level, and as appreciation grows, that creates equity. So the difference between what you owe on a house versus what the house is worth. And then there's some great tax benefits that still come along with buying a house. In fact, I had a client just text me just a little while ago, purchased his house last year and looking to get his interest statement so he can submit that to his tax advisor to see if there's any tax deductibility there. So a lot of great things that come along with owning a home. So as we kind of launch into tonight's discussion, we're going to start by taking a look at our rent versus buying calculator. So what this does, it kind of helps us with budgeting and figuring out kind of where we're at right now, where do we want to be when it comes to home ownership. So I'm going to walk you through a scenario, and we'll kind of share with you kind of the ingredients of this kind of side-by-side rent versus buying calculator. And then all the material that I review with you this evening, we're going to send back out to you via email. So you'll get an email from Ken Fleck tomorrow morning with all the information from tonight's discussion. So let's go ahead and jump in. Hopefully you guys can see my screen okay. And first of all, let's plug in. I'm going to go in a little bit lower on the rent. We're going to assume rent of about $1,500 per month. And if you can see on my screen here, I'm going to be inputting everything on this side of the screen. So $1,500 in rent. We'll assume renter's insurance of $15. And then we're also going to add in potential rent increase of 3% annually. So when I renew my lease at maybe at the end of 12 months, potentially that rent could go up by 3%. And then let's go ahead and plug in a purchase price of home. So let's go ahead and leave 400,000. I know that's going to vary. That's going to vary based upon where you're going to purchase in Arizona. And by the way, our content for tonight is going to be Arizona based. So if you're joining us from California or maybe another state, obviously we can kind of talk offline about maybe the different nuances by state. But ultimately, this content tonight is going to be focusing on Arizona. So for our purchase price, 400,000, we're going to assume a minimum down payment of 3%. Okay, so we'll go ahead and add that 3% in there. And then we're going to go ahead and look at property taxes. Property taxes generally are going to be 1.25% or so of the purchase price. So that's something we're going to factor into our budget. We also want to take a look at homeowners insurance. Homeowners insurance is going to insure the house as well as the contents, structure of the home. So we're going to budget for that about $1,000 per year. And then the other thing we want to add into our budget is maintenance. So obviously if something happens to the home, no longer can we contact our landlord to have that item fixed. We're going to have to make sure that we budget for that out of our own expenses. Quick side note, when it comes to financing a mortgage and you put less than 10% down for your mortgage, usually you're going to need to have what we call as an impound account. And an impound account allows the mortgage servicer to pay out your property taxes and your insurance through your mortgage. Usually property taxes are paid twice a year. Homeowners insurance is paid once per year. So usually your mortgage servicer will set aside those funds to be able to pay those two components. So property taxes and homeowners insurance. But we're going to put it into your budget so we can kind of look at that in our overall monthly budget comparison side by side. And then for loan information, we'll assume a 30-year fixed mortgage. That's mostly what our first-time home buyers will be doing. And then interest rates, which we're going to talk a little bit about later, because that's a hot topic today. We're going to put 3.875 for our discussion. And then origination charges, those are going to be charges that the lender will charge and is part of your closing costs. Origination charges can vary by lender. For us as a lender, we charge a $910 processing fee and a $895 underwriting fee. For our U of A alum, that processing fee gets reduced from $910 to $160. That's a nice little benefit. Discount points, that allows you to buy down your interest rate by paying additional cost in your closing costs. Usually 1 point, which is the equivalent of 1% of your loan amount, equals about a 0.25% reduction in interest rate. So, you know, it depends on what your recoup period is to buy down your rate, but generally the recoup period can be anywhere between 5 to 6 years. So we got to make sure that if we do pay additional costs to lower our rate, that it really does make sense. And then other settlement charges will be the other closing costs. Now, I would recommend budgeting about 2 to 3% of your sales price for closing costs. So when we think about savings, we're going to have to save our minimum down payment, which is 3% or $12,000 in this scenario, plus our closing costs, which can be anywhere between $8,000 to $12,000. Okay, so when we look at budgeting and savings for the home, we're probably going to be looking at anywhere between $20,000 to $24,000 in savings. We're going to talk a little bit about home buyer assistance programs later on this evening, but ultimately that's kind of where we would want to set our targets for from a savings standpoint. So when we look at continuing to rent over the next 7 years and my rent increasing, 3% over the 7 years, my total payments on average will be about $1,515 per month, versus if I purchase a house, it's going to be $2,781. So my payments are much higher on a mortgage. When I look at the return on investment by purchasing versus renting, it would actually make more sense for me to continue to rent in that scenario. Now, if I go ahead and plug in my appreciation, which that's going to be an important component here, our appreciation of 3%, my selling costs. If I go ahead and plug those numbers in, let's actually do it. Let's look at it a little differently here. So if we go ahead and plug in, I'm actually going to raise the rent, because actually, technically, if you're renting at that level, actually, I'm going to lower the purchase price a little bit to show you the difference of it looking from a buying perspective. So if you went ahead and bought at, we're going to put 300,000, and I know this will look a little different for each part of the market. There's where you would see the move over to the buy side. So stretching from a $1,500 budget, bouncing up to $2,700, obviously renting is going to make more sense just purely from a budgeting perspective. But if we went ahead and looked at a lower priced home, then it could make a little more sense, because now my opportunity over 7 years would be about $44,000 in savings by buying instead of renting. Now that's taking into consideration appreciation, tax benefits that come along with home buying. And kind of going back to that earlier example that I had here. So same rent payment of $1,500. Now my mortgage payment's a little bit lower, about $500 a month lower at $2,200 per month. Now that's where I can kind of tip the scales and make a little bit more sense out of buying. It's not typical for our first time buyers to buy up so high from $1,500 a month rent to $400,000, but everybody's living arrangement looks a little bit different. Some people are renting a smaller place and trying to really conserve cash, and so they can eventually buy. So it may not always make sense for you to move from renting to buying, but you have to kind of look at the potential upside. So our job here this evening is not to convince you on how, to buy. It's just to give you all the information so you as a first-time home buyer can decide on, is this my plan for this next year or maybe 2 or 3 years out? Okay. All right. So that's our rent versus buying calculator. I'm going to go back into our slideshow here. All right. So we should be back on. Okay. Okay, so one of the components of that rent versus buying calculator is looking at our housing appreciation rates. So this chart kind of depicts what's going on in the state of Arizona, and it's not indifferent to what we're seeing going on across the country. So what we have is limited supply, high demand from buyers. And so right here, this gray line represents obviously the pandemic. And once we hit in 2020, just after March of 2020, we saw massive appreciation rates. Arizona is probably on a higher pace than other bordering states like California, but you can really see just a swift move up in appreciation. And again, supply very low, high demand. New construction still is limited supply, resale homes. So that really obviously put a strong upward trajectory on prices. Now the question is going to be, what does that look like in this year's spring and summer buying months? We're going to see interest rates that are higher than we saw last year. So we're probably close, almost to a full 1% higher in interest rates than what we saw last year. So we'll see how that changes some of the buying power and maybe some of the buying behaviors for some of our buyers out there. But our hope is that we'll see more supply come onto the market, and obviously the demand will probably still be there, but hopefully that'll start to soften the market a little bit, and especially allows us as first-time home buyers to be able to hopefully enter the market. We're still seeing a lot of activity out there. It's not uncommon to see 18 to 20 offers on a property, so that definitely still happens in this market. The other thing that's moving buyer demand is interest rates. And we've had just incredible interest rates for the last couple of years. So rates touched down as low as 2.625, which was right about there. And we didn't really expect rates to enter that low of a level. We thought, we might see sub 3% by the end of 2021, but they really got down much quicker than that. And now we're starting to see this incline in rates. So over the last 2 months, we've seen this steady kind of drive upwards in interest rates. And as you can see here, and this, by the way, this blue line represents the 30-year fixed mortgage. You can see a really swift upwards. We've seen interest rates adjust by about 0.5% just over the last month. They really haven't slowed down. And as you probably all know, next month, the Federal Reserve is more than likely going to raise the federal funds rate by 0.25%, which hasn't been done over the last 2 years. So we are going to see kind of this upward trajectory. Now, I think a lot of what we're seeing right now in interest rates for mortgages is already kind of baked into what's going to happen next month. So our projections initially going into 2022 was to see interest rates around where they're at right now, but we're already here and we're at February 9th. So it'll be interesting to see how interest rates play out. The big watch right now is inflation, just to see what inflationary numbers do, because ultimately inflationary numbers are going to have an impact on what it looks like from interest rates. But I think as first-time home buyers, we want to be mindful of that because that will change a little bit of our purchasing power. One of the things we'll do as part of a consultation, if we get a chance to connect with you, is to kind of build out a home buying game plan for you. And one of the things we do is we look at interest rates and just show you exactly where they're at, where they're trending, and give you an idea. So as we're building that home buying budget, you know exactly what to expect or what's on the horizon when it comes to interest rates. So as we kind of build a home buying game plan and just figure out what this journey towards homeownership looks like, one of the things we have to take into consideration is credit. Credit's going to drive interest rate offerings, which you just talked about just a little bit ago. It's also going to drive mortgage insurance and just some of our overall program offerings. The minimum credit score generally for loans is going to be 580 to 600. Now we have 600 on this slide, but we can go as low as 580 for the minimum score requirements. And that's on an FHA loan, which you're going to learn a little bit more about programs in just a bit. And so we'll talk more specifically about that. When we look at the FICO score, we are going to use the mortgage FICO score, which I believe is the FICO 8. So for those of you that use credit monitoring, the score that you're going to see is more often than not a credit card score, which is different than the credit risk model that we use on the mortgage side. The calculation weighting looks something like this. So 15% of the credit score is how long you've had credit. 20% is going to be how much credit I have in use, but it's more importantly, new accounts that I've established, but also inquiries that I've had on my credit report showing that I've tried to access credit. There is two different types of inquiries. There's a hard inquiry and a soft inquiry. The soft inquiry allows lenders to get visibility to your credit report, but doesn't impact your credit score. Hard inquiries, if you do several of them and they're for different industries, can negatively impact your credit score. So you want to be careful to do hard inquiries. Now, with the mortgage industry as well as the auto industry, if you initiate a hard inquiry today, you have a 30-day window of time to have as many inquiries in that particular industry as you want to do your due diligence in looking for different financing options. So that's a 30-day window, but it starts from the date of day one inquiry. Now, in going through the process with us and building a home buying game plan for you, we're just going to start with the soft credit pull, so you don't have to worry about that clock ticking for the 30-day window, but this is something to keep in mind with as you kind of do some of your discovery work. 30% of the FICO score calculation is how much I owe. That's also known as utilization of credit. And that's relevant for revolving lines of credit. So credit cards, personal lines of credit, things of that nature. Our goal is to try to have the lowest utilization as possible. So if we're, let me tell you a little bit about utilization. So utilization is the credit limit versus your credit balance. So if I have a credit limit of 10,000 and my balances are 5,000, my utilization is 50%. Ideally, you want to have your utilization below 10%. If we're trying to just pay down some debt because we have some maxed out credit cards, we want to try to get that at starting point below 50%. If we're really kind of pushing down that debt, then we want to try to get at least below 10% utilization. Now, with your credit card accounts that you have, your credit card issuer is sending out information to the credit bureaus at the end of your billing cycle date. And so even though for some of us that we may pay right on our due date and maybe we pay off our account, the balance that you have at the end of your billing cycle date is still going to report out to the credit agencies. So what I recommend and try to do your best to improve your credit score is try to pay off or pay down your credit balances before the end of your billing cycle. Because if you do that, that's going to enable you to have a higher FICO score because your utilization is much lower than what it would normally be reported. So if your due date's on the 4th, but your billing cycle is on the 20th, try to pay down or pay off that credit card before the 20th, let's say on the 19th of the month. Okay, so that's credit utilization. The last component is going to be payment history. So that's how I've paid my bills. Generally, well, that's going to be 35% of the weighting, but generally the payment history in the last 12 to 24 months is going to weigh the heaviest on your FICO score calculation. Okay, so if there's any late payments, they're generally going to be categorized as 30, 60, 90, and then 90 plus days delinquent. So we obviously want to keep our bills paid on time. We don't want anything to run over because that could obviously negatively impact our credit score. When we look at credit score in financing, we're always going to look at the middle credit score for the client. So let's say, for example, I have a 760 score, 740, and 720. The middle score is going to be 740. So that's the score we'll use for qualifying purposes. If we're going to apply jointly with a spouse, and that spouse is 700, 720, and 680, the lowest score between those two applicants is going to be 700 on the mid score. So that's the score that we would use for the qualifying. Okay. So that's what that'll look when we put together your financing options. Looking at credit and how long negative items are going to stay with you, this is kind of a little chart to help guide you through that. So credit, those hard inquiries, those are going to be on your credit report for less than 2 years, or 2 years or less, I should say. Late payments, they may not impact you beyond 2 years, but they will stay with your credit report for 7 years or less. And then things like public records like bankruptcies, state tax liens can be on there 10 years or less. Okay, let's talk a little bit about student loans, because student loans generally come up as a topic for us as we're consulting with clients. And student loans have a calculation that we have to look at when it comes to qualifying for a mortgage. While student loans or federal student loans are in forbearance right now because of the CARES Act, and I think they were extended out to maybe May of this year, we still have to count a minimum payment in the qualifying. Usually with conventional loans, we're gonna, not usually, but with conventional loans, the guideline is if you're on an income-based repayment prior to the pandemic, and let's say it was $250 per month on your $100,000 in student loan debt, that $250 payment is what's used to qualify you for your mortgage. Now, if you're not in an income-based repayment amount, and you don't plan on being an income-based repayment amount, then we have to default to 1% of the student loan balance. So in that case, it would be $1,000 per month. So that could obviously sway, that $750 difference could sway your qualifying. So income-based repayment options tend to be the best for clients. Now that's on a conventional loan. The FHA loan's a little bit different. And so with FHA loans, the default is 0.5% instead of 1%. So that same $100,000 in debt would be a $500 payment. Or if you have an income-based repayment amount, then that would be $250 per month. Okay, so most of the student loans, especially the federal student loans, are showing zero payment on the credit report. So that's why lenders, we have to go through our due diligence and verify the monthly payment, because we want to make sure that as we build financing, we have to create affordability for you, not just qualifying, just to make sure you're able to balance with some other monthly obligations beyond the mortgage payment. Let's talk a little bit about loan programs. And generally with first-time home buyers, especially, there's kind of two paths we'll go down with first-time buyer programs. There's generally either a conventional loan or an FHA loan. And for conventional loans, the minimum down payment is 3%. For FHA loans, it's 3.5%. For VA loans, for our veterans who have served, it's a 0% down payment. And there's also the USDA loans and jumbo loans. Now, USDA loans are for your rural properties. There's actually a mapping in Arizona that shows you what properties qualify for USDA. USDA has a 0% down option. And then jumbo loans are 10 to 15% down. Now, jumbo loans aren't typical for our first-time home buyers, but they're for our buyers that are looking to finance above $625,000. Now, across Arizona, that is the conventional loan amount. And so there is in other markets, so if some of you are joining us from California, there is high cost of living markets that can go beyond that conforming limit. But in Arizona, it's a base amount. And with conventional and FHA loans, because they are typically the choice for first-time home buyers, like I said, there's gonna be a 3% down minimum payment for conventional loans. The minimum credit score is 620. Where FHA loans go down to a minimum credit score of 580, but it does have that 3.5% down payment requirement. Now, when you purchase a home and you put less than 20% down, there is private mortgage insurance, or what we call PMI. On a conventional loan, the PMI is based upon three kind of components: your credit score, how much you put down, and how much you finance. So that builds a PMI calculation, or factor, I should say, that gets included into your monthly payment. Now, PMI for a conventional loan generally has a cancellation option. So when you have 2 years in your home and 22% equity that has appreciated, you can apply to have that mortgage insurance removed, but that will come into play when we put less than 20% down. Usually mortgage insurance is in tiers by down payment. So it's 3% down, 5% down, 10%, 15%. And then of course, once we reach 20%, we have no mortgage insurance. Now, FHA mortgage insurance is a little bit different, because regardless if you put down 20% or not, you're still gonna have mortgage insurance. That factor for mortgage insurance is 0.85% of your loan amount. So it's a 0.85% factor. So if we borrowed $625,000, that would be somewhere in the $5,000 a year range. And then we divide that by 12. That would be your monthly mortgage insurance. Now, FHA also has, in addition to monthly mortgage insurance, upfront mortgage insurance, which is 1.75% of your loan amount that gets added on to your financing. And so there's kind of those two components with FHA mortgage insurance. But one of the big things with FHA loans is that the mortgage insurance does not have a cancellation option. So to cancel the mortgage insurance, you essentially have to select another loan product down the road when you can refinance. Or of course, if you sold the property, then you would eliminate that debt at that time. Now, if you put down 10% or more in an FHA loan, the mortgage insurance automatically falls off at 11 years. So kind of looking back now at the conventional loan FHA program, you know, a lot of clients will say, well, why would I go down that path? Well, there's several different reasons. It just depends on what makes the most sense for our buyers based upon maybe credit situation, past challenges like bankruptcies, maybe short sales or foreclosures. Because FHA tends to have a little more leniency when it comes to some of those timeframes on bankruptcies, short sales, foreclosures. As you heard earlier, the minimum credit score is a little bit lower at 580 on FHA versus a conventional loan of 620. So it depends on, as we customize the financing, what makes the most sense for our buyers, but that does give you kind of a sense of what those look like for those programs. Oh, I didn't know we had this slide. So this is kind of just what I just described to you earlier, which is our kind of our PMI breakdown. So this will be a good reference point for you. So as you're selecting those different products, you can you know, have a explanation, if you will, on kind of how PMI is structured. So this is your monthly MI that we just described to you on the conventional loan and the three components, and then FHA, the 0.85% factor and the 1.75 upfront MI. As you can see, when you look at the PMI differences, comparing a 3% down conventional versus a 3.5% FHA, you're looking at $183 roughly versus $324. So there's pretty big difference there. Obviously, your amount finance is a little higher with FHA when we add the upfront mortgage insurance. So those are all kind of factors that we want to think through as we build a home buying game plan. Okay, let's go ahead and transition from programs. Now we want to talk a little bit about qualifying income, and I'll go through this relatively quick because I want to kind of just dispel some kind of misconceptions about what proof of income you need as a future first-time home buyer. Now, the documentation that we'll need from W-2 wage earners is usually your last 2 years of your W-2. So all of us attending, if we're a W-2 employee, we probably got our W-2s just a couple weeks ago. So you need your last 2 years W-2s, last 30 days of pay stubs, and then we'll verify your employment. And that's generally a written verification or verbal. That verification does not have to be done prior to pre-approval. It's usually once we're in escrow to purchase our home. Now for self-employed, it's a little bit different because we're gonna need the last 2 years of your taxes, probably a year-to-date profit and loss statement, maybe a balance sheet, and then we'll also verify the business in some way, whether that's a business license, CPA letter. So those are the typical documents that we'll need. If you go through the home buying process with us, our application is kind of intuitive, so it will prompt you based upon your questions to the application. It'll prompt you to upload certain pieces of documentation. Now, as we look at building our plan for home buying, you know, there is some questions that come up for our first-time home buyers, and a lot of those things are around income when it comes to what can be used and what can't be. As a lender, we do have to verify 2 years of employment and or education. So let me give you an example. So if I've just graduated from U of A in the fall and I'm getting ready to start my first job, let's say spring, right? If I got a degree in accounting and now I'm going to work for Deloitte in the spring, I've shown that I had 4 years of undergrad supporting my career of what I'm going to be, the path I'm going in my career. So even though I haven't had 2 years on the job, I do have 4 years of education supporting what I'm doing. So that would fulfill the 2-year requirement. So that gets asked quite a bit. Another thing that comes up often is if I'm switching jobs. So if I, you know, move on from a job and I've only been there for a year and I'm moving to a new job, can I still count that new income? And the answer is yes, as long as we can verify a full 2-year work history. In some cases, when we're applying for a new job and all we have is an offer letter, but we haven't started that job yet, some cases we can pre-approve you subject to you getting your first payment or your first pay stub from the new employer. So we can just look at your kind of your compensation package to the offer letter and determine qualifying based upon that. Another question that comes up is dual employment. That we typically see that maybe in the healthcare industry, where if I'm working 30 hours at one hospital and maybe 20 at another, can I use both sources of income? So you can use both sources of income if you've worked for both organizations simultaneously for the last 2 years. If I've just worked there for a month, but I've been in the other organization for the last 6 years, then I would only be able to use the tenured position at 6 years with the one employer. So that'll come up every so often. Now, if I have a W-2 employment, but I'm also self-employed and I work maybe with Uber, I drive Uber on the side, I have, in order to use that self-employment income along with my W-2 income, I have to show that I've been doing both simultaneously for the last 2 years as well. Okay, so that comes up quite often. So that's on the income section of kind of our home buying game plan. Now, another thing that we look at in evaluating qualifying for our first-time home buyers is a thing called debt to income ratio. Debt to income ratio takes into consideration our pre-tax income versus our monthly obligations. So those monthly obligations will be student loans, personal loans, credit cards, personal lines of credit, things that basically that will generally show up on our credit reports. We'll take that plus your expected housing expense and we'll formulate a debt to income ratio. That debt to income ratio generally shouldn't be any higher than 43 to 45% of my pre-tax income. Now that's for qualifying, but it doesn't necessarily indicate affordability. And so that's a conversation that we're going to have as part of your consultation. This is what a debt to income ratio looks like. So it takes into consideration your principal and interest, your taxes, your insurance, the PMI, which we learned about earlier today, as well as maybe homeowners association expenses. Those will come along with townhomes, condos, things of that nature. So let's say I'm spending $2,000 a month, or my projection spend is $2,000 per month as a homeowner, and I have another $750 in debts. If we take those obligations of $2,750 versus my monthly income of $7,500, then my debt to income ratio is about 36.7%. Most of our first-time home buyers feel really comfortable around 33 to 36% debt to income ratio. So that's generally what we see. Now, if we have additional income in the household, but maybe we can't verify it, or maybe we have a spouse that has income stream, but it's not going to be part of the loan, then maybe we might recommend going a little bit higher up to the maximum income limits. But as a rule of thumb, we really try to target first-time home buyers to stay within that affordability range of like 33 to 36%. That's a conversation that we're going to have as part of your consultation. Okay, so we'll take you through that full debt to income ratio and talk about affordability. Now I've kind of thrown out a lot of information really quickly. Any questions I can help for the group, or? Okay, good. Again, if you have any questions as I'm kind of rolling through tonight's content, please feel free to go ahead and answer or send us a question for the Q&A, and I'll bring those back to the group. The next thing we want to look into is down payment. So as we learned a little bit earlier, minimum down payments are going to be 3% or 3.5%, but we also have to factor in closing costs, which can be anywhere between 2 to 3% of our sales price. These are some of the acceptable sources for down payment. So checking and savings accounts. Cash cannot be used for a real estate transaction. So we have to paper trail everything used in a real estate transaction. Any large deposits have to be sourced. So over the next 2 or 3 months, many of our clients are getting tax refunds, hopefully. So those are considered large deposits, but they can be paper trailed because they go back to the US Treasury, so we can see kind of where that money came in. But as a rule of thumb, every large deposit has to be paper trailed. Retirement accounts like 401ks, 403bs, IRAs, those can be used, but you want to talk with your tax advisor, maybe your financial planner, about maybe, the implications of using those assets, because, they can take away from your appreciation of that asset, especially with 401ks and 403bs, but also you got to think about the tax consequence that can come along with accessing those assets. Gift funds can also be allowed for your home purchase. Usually most assets need to be seasoned 60 days. However, with gift funds, they can be immediate. So if we have a family member that's willing to help us out with maybe $10,000 towards our home purchase, that money can be used right away. Generally, the donor would need to complete a gift letter. In some cases, provide proof of their asset, like a bank statement, and then proof of the recipient or you as the buyer receiving those gift funds. Now, when it comes to home purchasing, generally with the 3% down payment and the closing costs, we're going to probably need to save maybe $20,000 to $24,000, depending on what sales price we're going to buy at. But as first-time home buyers, there's great tools out there that are still available to you to be able to purchase as a first-time home buyer and help minimize some of your out-of-pocket expense. So we're an approved lender with Arizona Home Plus, which is a home buyer down payment assistance program, and allows you to purchase and help kind of minimize those out-of-pocket expense. Now, interest rates will vary on these programs based upon how much assistance you can take. There's two different lanes you can go down, so to speak. There's a forgivable DPA, which stands for down payment assistance, and there's a non-forgivable, but the non-forgivable is only available in Maricopa County. Okay, the DPA forgivable allows you to borrow up to 2 to 5%. So does the non-forgivable. One has a 3-year no interest, no payment, and it's basically deferred. We call that a silent second. So you can take advantage of the assistance. Let's say it's 5%. And that's 3 years with no interest, no payment. Now, when you sell the home or if you refinance, then that down payment assistance will need to be paid at that time. But on the forgivable, it's basically forgiven after 3 years. If you sell the property earlier than that, then you would pay back 1/6 per month of the rate of the assistance. So that's kind of a cool program. And then the non-forgivable, you can still borrow the same amount, 2 to 5% of your loan amount. But for the life of the loan, there's no interest, no payment, and then it still has the deferred option, but you just don't have the forgivable component. And that is just available in Maricopa County. So those are options to help decrease that amount of money out of pocket. Let's kind of look at it more real time. So let's say I'm going to purchase at $350,000, for example. As we learned earlier, the minimum down payment is $10,500. So we need to set aside that 3%, plus we got to factor in those closing costs, which in this example, we put $7,000 to $10,500. So I'm going to need about $17,500 to $21,000 cash on hand, so to speak, to be able to purchase my home. So not always available for all of our first-time home buyers. Most first-time home buyers that we work with have anywhere between $6,000 to $10,000. And really could use help with an assistance program. So if we look at the same scenario with the Home Plus program, we could still buy that $350,000 house, but with the cash to close, we could add in anywhere between $6,800 to $17,500. So instead of having that higher out-of-pocket expense, now I can reduce that out-of-pocket expense down to maybe $3,500, maybe $14,200. Just depends on what level of assistance I want to take. And of course, you'll have a corresponding interest rate based upon how much you take. Now that interest rate impacts the first mortgage rate, and interest rates fluctuate daily. So depending on when we find our property and we want to take advantage of this program, Home Plus will set interest rates for that day. As part of your consultation, we can go through the Home Plus program to see how that can help, give you a benefit for you in your home buying game plan. Now there is some eligibility requirements. There's a minimum credit score of 640. Maximum debt to income ratio. So that debt to income ratio of 45, you can actually go up to 50 with this program, which is a great feature. Now, if you're looking into manufactured homes, maybe a VA loan or a USDA loan, those can also be used with this product, but the maximum debt to income ratio is 45%. Now the income qualifications on most products are by household size, but this is just based upon the applicants that we have. So as long as you're under $112,785 in annual income, you could potentially be eligible for the program. If you have a spouse and maybe one of you are just looking to apply on the mortgage, and maybe your combined income exceeds the $112,785, you could potentially apply with just one applicant that has less than that income limit and stay below the required income limits for the program. There is homebuyer education that's required before you can purchase the home, and we can provide all the links to you as part of our consultation. Okay, so that's the Arizona Home Plus program. Another great tool that can help you out, as it doesn't have to be a first-time buyer, it can be a second or third-time buyer, but I know most of our group tonight is first-time buyers. And that's the medical professionals program. I was going to say physicians program, but it's medical professionals program. So it includes medical doctors, dentists, teaching professors, and some of our newly licensed medical residents. The features with this program that probably the most beneficial to our medical professionals program is allows us to go beyond some of the conforming limits in certain markets, but more importantly, student loan debt that you may have coming out of school. may not count against you for your qualifying where it would with more of a traditional program. It just allows a little bit more flexibility. So, if I've come out of school with $300,000 in debt, instead of taking on that $3,000 payment into your qualifying, in some cases with the medical professionals loan, that would not be included into your debt to income ratio. So that's a really great product that we can take a look at for our clients that it would be applicable for. Okay, so we're going to talk now a little bit about the home buying process. We call this our 6 steps of home buying. So we've created these milestones just to give you an idea of what to expect as you move through that journey towards home ownership. The first place we start is going to be pre-approval, and a pre-approval is a certificate that we present to a seller that shows the seller our eligibility for qualifying. Specific in Arizona, there is a pre-approval document that we'll provide to you that does actually require your signature. That can be edited based upon the offers you make, but it's presented to a seller to outline kind of your financing so they know exactly what to expect. If you do work with a licensed realtor in Arizona, they will have a copy of this for you, and of course, as your lender, we'll provide that to them. So I'm going to walk you through what that looks like. So a pre-approval is going to be the output of a consultation. So it's part of your overall home buying game plan. It's usually good for 60 days, but that can be recertified at any time. And generally what we'll do with pre-approvals is we'll update these as we go through the home buying process. So let's say we get approved for $400,000, but we fall in love with a house for $350,000. We can always amend that pre-approval to match your offer price. So that's really easily to do. But again, the pre-approval is a certificate that allows the seller to see exactly how your financing is set up. So that's going to be the output of a consultation. Now, step 2 is going to be our house hunting. So that's the fun part of things. So that's where you get a chance to work with your realtor to look at different options of homes. And then generally your realtor will reach out to us, the lender, to maybe get updates on your pre-approval, talk a little bit more about your qualifying to make sure that they're designing the offer to make sure it's the most appealing for the seller. Now, we all know this is a seller's market right now, as we kind of learned a little bit earlier this evening. So it's really important to have your financing designed so you can be able to perform and execute on an offer. So the house hunting phase, you're going to have a realtor that you're going to work with. We do have a network of preferred realtors in the Arizona market. So if you do want us to introduce you to someone that can help you with home shopping, more than happy to do that after we've completed your consultation. In Arizona, realtors are paid for by the seller. So we always recommend taking advantage of that resource to help guide you through home shopping, but helping with your inspections and some of the other nuances that comes along with the home buying process. Now, step 3 is going to be entering escrow. So that means our seller has now accepted our offer. And the escrow process, or the escrow time period, usually is about 30 days. So from the time of acceptance to when you get your keys to the home at step 6 at the end of the process, it takes about 30 days. Step 3 means the seller's accepted our offer. Usually as a buyer, you're going to be making an earnest money deposit within 2 to 3 days of that acceptance. And then as soon as we get word that your offer has been accepted, I'll give you a call to schedule your video consultation. And that's a follow-up consultation that we'll do to kind of go through your financing, talk about interest rates on where they're at, your monthly payment, out-of-pocket expense. Make sure you just feel really comfortable with all of your financing. At that time, your realtor will be organizing inspections if applicable, and then we'll be ordering an appraisal of the property. And shortly after that point, you're going to be receiving what we call your initial disclosures. And those can all be done via e-signature. And those will also outline what interest rate selection looks like, monthly payment, and like I said, out-of-pocket expense. Now, I mentioned earnest money deposit. What an earnest money deposit, it's a good faith deposit that's put in escrow, and it's usually 1 to 2% the equivalent of your purchase price. That money that's put on deposit goes towards your total out-of-pocket. But it's a good faith deposit provided in escrow, so the seller knows that you have an interest in obviously this purchase and being able to perform on your financing. There's also contingencies that are usually part of the contract that allows you to do your due diligence as a buyer. That usually includes an appraisal contingency, which allows you to ensure that the appraisal comes back what the house is being, what your offer price is for the house. So we want to make sure that the appraisal matches the offer price. So if I'm buying the house for $400,000, we have to appraise it for $400,000. And that's to give you peace of mind that you're truly buying something that's worth that value on the market. Inspection contingency that allows your agent and yourself to be able to do your due diligence with home inspections, pest inspections, maybe a roof inspection. And then your loan contingency that allows you to get your loan approved and to be able to have the financing completely finalized. The pre-approval gives you an indication that your financing is in line, but the loan contingency and the loan approval has an underwriter that has officially gone through and underwritten your loan. So that step will move us into step 4. And so I mentioned to you underwriting approval. So step 4 is the processing of all your documentation to make sure that we verified assets, income, verified your employment. Generally by that stage, we'll be talking, well, we've talked about locking in your interest rate, but we could probably lock in your interest rate at that time. And then we'll submit everything to the underwriter who will issue your loan approval and then now move us to step 5. Now, by the time we get to step 5, we're probably about 3/4 of the way through the escrow process. And at that time, we have now a final loan approval. You're probably at the end of your contingency period. So if everything is up to your satisfaction in terms of the inspections, we have your loan approved, appraisal checks out great. Then if you feel comfortable moving forward in the process, you're going to sign off on your contingencies and your realtor will help you through that. We as a lender will also be issuing to you a final closing disclosure. And that gives you a 3-day cooling off period to make sure that the financing is what you expected. So there's of course no surprises. And that cooling off period, after that has elapsed, that will lead you to the very final step, which is called closing your loan. And that's step 6. That's where you sign final loan documents, and those have to be done in front of a Arizona public notary. Everything else leading up to that point can all be done e-signature, but those final documents have to be done in front of a public notary. That process of signing takes about an hour or so. And then once you've completed that task, you will be wiring or delivering a cashier's check for the final amount of money that's owed in your transaction. Now, there's an escrow company involved in the process. You've heard that escrow terminology earlier today. Escrow's role is to ensure that all the incoming funds from you, as well as from your loan that you're getting, is all balanced. It's basically balanced out to what the seller's expecting with their proceeds after all costs and everything. Once all that money has been balanced, the escrow officer will give the okay for documents to be released to the county recorder's office to record a grant deed, and that transfers ownership to you. And they'll record a deed of trust, which is the kind of the security instrument that's used to secure the deed to the house for our collateral interest in the property. And once we've gotten confirmation, or the escrow company has gotten confirmation of those documents being recorded, then you become the official owner of the home. And then you'll make arrangements with your realtor to get the keys to your home and get a chance to high five and celebrate this big accomplishment, because obviously it's a huge deal to be able to make it through that journey through homeownership. That journey of homeownership doesn't come without a little stress and anxiety, and we try to kind of help you through that, keep you in balance there, because there's a lot going on, a lot of moving parts. But you know, we do I think a really good job to stay high touch with our clients as we move through that journey of the 6 steps of home buying. Now, before we get to step 1, there's a consultation that we'd love to do with you, and that's where we do either a phone call or video. I really encourage you to do video. That allows us to build that home buying game plan. So for the consultation, you complete an online application. We do a soft credit pull, like I mentioned earlier, but that doesn't impact your credit score. You'll upload proof of income, assets, 2020 W-2s, 2021 W-2, probably your last couple pay stubs, bank statements. And once that's completed, you'll schedule your video call. In fact, the links to the consultation are right here on this slide. And that's where we get a chance to spend 30 to 45 minutes building that home buying game plan. And if you decide to get pre-approved, we'll get you pre-approved so you can start on the journey towards home ownership. And that's a free service we provide because we really want to make sure that our clients are prepared as they decide to purchase. So whether it's a this year goal or a next year goal, at least you know kind of what your budget looks like and what the process would be for you accomplishing that goal. Now, after leaving tonight's workshop, if you just have some questions maybe that you want to run by me and just for different scenarios, we can always schedule an intro call, and that's still a free service just to kind of go through maybe what scenarios you have with home ownership. This is kind of the framework of a consultation. So like I mentioned, it's about 30 to 45 minutes, but it's just a lot of looking at affordability, building that game plan for you, with budgeting, looking at different locations for your home purchase, taking a look at the application, just make sure you feel really good with interest rates, payment selection, all the things that are going to be really important for you in deciding to take the next steps towards home ownership. Now, as part of our U of A partnership, there is an exclusive discount. So we give a $750 discount in our closing costs. I think you heard me mention that a little bit earlier. So normally we charge a $910 processing fee. We drop that to $160, so it saves our alumni $750. So, and if you're also joining us from any other organizations or partnerships that we have affiliation with, we pass along that same discount. We really want to make sure we equip you with the best product available. As I mentioned earlier, our consultations are completely free. So if you want to build your home buying game plan today, we'd love to be able to connect with you on that. We understand this is a big deal in home ownership. This is probably going to be one of the largest investments you're going to make in your lifetime. So we want to be your trusted partner in that process. And for those of you that need access to preferred realtors, or you have a real estate partner, we want to make sure that everyone that you work with in your process has your best interest in mind. There's some great tools that we have available to you. One of them includes our mobile app, and that allows you to start the application right there from your phone, or you can take the desktop version as well. Beyond the application, you can follow the kind of progress of your loan as you move through the different milestones, as you saw earlier. And you can also run some different calculations right from your phone. Really great calculator. I do hear from our clients that we're working with, some of the online calculators don't get as detailed, or they're not as accurate, I should say, with the calculations. So that mobile app does a great job of kind of giving you more specific on your payments. And as we teach these workshops every couple of weeks, whether it's California or Arizona, we love to hear what our clients are saying about us. A lot of our graduates, I should say, from these workshops, they have their testimonials on our Instagram or Google or Yelp, because we love what they're saying about their experiences with not only just the workshop, but their experience in home buying. So I would really encourage you, if you have time, check those out. Follow us on Instagram, Facebook. We really are proud of kind of what our clients are saying about us. And if you do want to schedule some time with us, please feel free to schedule an appointment here. But we're always trying to make ourselves available. So here's all my personal information. So if you want to just reach out to me via text, email, we can make sure we get your questions answered for you. We really want to be a partner for you in this journey towards home ownership. Now we're running up right at the end of tonight's session, but I do want to keep the lines open for any questions that we do have for the group. So we'll stay online for a couple minutes, and then we'll go ahead and wrap up tonight's discussion. So I'll keep us online. I'm gonna go off camera for a little bit, but we'll come back online to go ahead and sign off in just a few. Okay, it looks like we're good on all of our questions, but of course, if you do have questions that you want to just take offline, feel free to reach out to me directly. I'm more than happy to answer those for you. Or like I said, if you do want to schedule an intro call or maybe a consultation, if you want to go a little further with the meeting, that's great. Thank you so much for joining us this evening. Again, we teach our workshops every couple weeks. If you have friends, family, maybe some coworkers that think you might benefit from this educational material, they can always check out some of our upcoming workshops at mortgageeducate.com. So again, that's mortgageeducate.com. It's a free service that we provide across all the markets that we serve. So thank you so much for joining us this evening. I hope you have a wonderful night, and I look forward to connecting with all of you soon. Talk to you soon. Bye-bye.